You put in the hours, negotiate the raise, and watch that high salary hit your account. But earning it is only the first step. Your ability to actually build wealth is dictated by how effectively you navigate the internal mechanics of the Indian tax code. Before you can invest a single rupee, your gross income is siphoned off by income tax, neutralized by inflation, and diminished by investment taxes. Faced with this complexity, most earners try to lock away whatever is left in traditional safe accounts. Choosing the path of perceived safety often locks in a mathematical loss of purchasing power over time. We are going to map out the break-even points between tax regimes, expose the tax drag of traditional savings, and provide a framework to optimize your long-term capital gains. Ignoring these rules doesn't make them stop applying to you. It simply volunteers your potential wealth back to the government. Every financial year begins with a single calculation: which income tax regime will maximize your take-home pay? The old regime uses specific deductions as shields to lower taxable income if crossing a mathematical threshold. These shields cost you multi-year lock-in periods and strict administrative records. Choosing the new regime lowers base tax rates but removes shields entirely, simplifying filing over deductions. You lose the ability to offset your income with structural expenses like home loan interest or life insurance premiums. Finding your personal break-even point is the only way to know which regime is more efficient for your specific income level. The optimal regime choice depends on your willingness to proactively track documentation and lock capital into long-term tax-saving instruments. Beyond how your income is taxed, we have to look at how your savings are taxed, starting with the most common cultural default, the fixed deposit. The FD offers a powerful psychological sense of security, where your principal is shielded from the volatility of the stock market. Look at the real numbers. Your 100 rupee principal earns a small block of interest over a year. That interest is taxed at your income slab. High earners lose up to 30% immediately. Then, inflation pushes the total value below your starting line. When you combine slab rate taxes with baseline inflation, the fixed deposit yields a negative real return. This instrument protects your numerical balance from market crashes, but fails to protect the actual purchasing power of your money. Generating real growth requires market-linked assets, but that shift introduces a different set of tax rules. Profits on equity held for less than 1 year are classified as short-term capital gains. You retain the ability to withdraw cash at any time, but you pay a flat 15% tax on every rupee of profit you earn. By holding that same asset for over a year, you switch to the path of long-term capital gains. Under this framework, the tax rate drops to 10%, and a tax-free zone protects the first 1 lakh rupees of your annual profit. This strategy requires the behavioral discipline to remain invested through market fluctuations without selling. For those using the old tax regime, you can combine these benefits using market-linked Section 80C plans. These plans offer an immediate deduction at the start, market-linked growth in the middle, and a 100% tax-free exit at maturity. The trade-off is total illiquidity. Your capital is locked away and cannot be used for short-term needs. Unlocking wealth growth in India is a conscious decision to trade short-term liquidity for long-term tax efficiency. We map these choices onto this quadrant chart to find the strategy fitting your lifestyle. The hands-off earner prioritizes simplicity and liquidity, avoiding paperwork. Their optimal path is the upper left quadrant. Select the new tax regime and invest in direct equity held over a year. You accept a slightly higher base tax to avoid the FD inflation trap and the multi-year lock-ins of insurance products. The optimizer is willing to manage complex documentation to aggressively shield their income. This profile belongs in the upper right quadrant, utilizing the old regime, market-linked 80C plans, and annual LTCG harvesting to reach maximum efficiency. These asset classes and deductions were designed by the government to incentivize long-term capital formation. Mastering these specific frameworks provides the mechanical foundation required to shield your earnings from structural erosion.